Good afternoon, welcome to the Market Wrap number 107. Stuart Williamson here at the helm. This is APW. This week we cover research from Knight Frank and The Economist on how they believe the residential market in Europe and the UK globally will perform going forward. Thank you all very much for the shirt comments last week. I won't be setting up a YouTube channel purely for it, but do like this channel if you can, subscribe and press the remind button to remind you when the next one comes up. Why do we do this? Just to give clients information to help them make buying decisions. Okay, this last week, Knight Frank has revised its UK house price forecasts, and they're up. Basically, they're saying supply is rebuilding more gradually than anticipated, which means that house price growth is expected to end the year in high single digits rather than mid single digits. However, housing market stats continue to sit uncomfortably alongside other UK economic data, which is the truth, because we've got inflation at a 40-year high, interest rates at their steepest climbs in 13 years, but we have house price growth at 12.4%, as data from the Office of National Statistics showed last week, which is pretty crazy really. And that wasn't just an ONS anomaly, with both the Nationwide and the Halifax reporting the same double-digit growth in May. The housing market is clearly taking longer than anticipated to recover from the distortions caused by the pandemic, and especially from the stamp duty holiday. Knight Frank have therefore revised up their UK house price forecast to 8% from 5% in 2022. The new regional breakdowns for 2002 can all be seen on this chart. They have not changed any of the subsequent years, just this year. The UK has a 16.9% forecast growth over the 5-year period, they believe, as an average, with the best areas being the east of England, followed by the east and west Midlands, all above 17%. They still believe annual growth will return to single digits by the end of this year, as supply builds and demand is put under pressure by rising mortgage rates and spiking inflation. Basically, low supply has been the key story of the pandemic for the UK housing market. It's largely failed to keep pace with demand, particularly during the frenetic conditions of the stamp duty holiday. I mean, that stamp duty holiday, looking back, was crazy. It was a great idea at the time, good for the government, good to raise revenue, but bad for the economy. Basically, prospective sellers were not able to find purchase options of their own because of the vicious circle effect that ensued. However, now listings are picking up in recent weeks following the Bank of England's decision to raise the base rate to 1.25% and issue a series of stark economic warnings. I believe, and I think it is the truth, that more sellers are now come forward because they think house prices might well be peaking, and I think that probably is the case. That said, not all commentators agree with the bank's negative economic assessments. They cite the lowest rate of unemployment for nearly 50 years, the fact that we've still got near all-time lows on interest rates. These are all very positive factors, as we covered last week. Knight Frank also revised up their expectations for prime outer London growth from 5% to 5% rather, from 4%, and their prime country forecast to 7% from 5.5%. At the same time, prime central London, which has been lagging at most locations, has been revised up to 4% from 3.5%, and that is buoyed by strong domestic demand and international buyers coming into the marketplace. And quotes from Tom Bill, who's head of UK residential, says house price growth is peaking as supply rebuilds and mortgage rates normalise. But one lesson from the pandemic is that nothing reverts to normal overnight, which is particularly true in a relatively slow-moving market like residential property. They therefore expect a more gradual return to earth for prices. The distortive effect of low supply has also kept rental growth very high. A sharper slowdown in the sales market would have boosted supply and increased downward pressure on rents, as owners let out property that failed to sell for the asking price they wanted. However, that hasn't been the case. So Knight Frank expects stock levels to be particularly squeezed over the summer as high demand from corporate tenants and students exceeds available supply. We have therefore, not we, I don't work for Knight Frank, they have therefore revised up their rental forecasts for central London and outer London in 2022. They expect them to be 11% growth and 9% growth respectively, up from 8 and 5%, which is putting it back onto a par with the rest of the country. They say general rental growth is forecast to grow at 17.1% across the UK, with the East and West Midlands at 19.9%. That is quite extraordinary. So we have a real rental market. So from a buy-to-let perspective, it's a great time to be in there, even if the interest rates are going up, because the rent will outpace it. Now, the Economist has a house price forecast that's just come out. It predicts France and Germany to be the best performing markets during the next 3 years. The recession that was set off by the COVID-19 pandemic has strangely coincided, they say, with surging asset values, and residential property is no exception. And what they do is they take an equal weighted average of the 16 richest world markets, and they say that real prices have risen by 5.4% during the most recent 12-month period, based on available data, compared to 2.2% for 2021. In America, values in the 12 months to January this year jumped by 11%, the fastest rate since 2006. So they're saying, does the boom have further left to run? Bulls and bears both make strong cases. Buyers note that the fiscal stimulus and low consumer spending has left households' balance sheets unusually healthy, that remote workers encourage people to prioritise their living environment, and that interest rates are near all-time lows. Excuse me. Sellers counter that, saying that the rates have been rising quickly, that mounting debt will force governments to tighten their belts, and that rents in big cities have fallen sharply. They have fallen sharply, but they're now coming back, as Knight Frank say. To help sort through this uncertainty, they fired up what they call their Economist Statistical Forecast Machine for house prices. It was built in 2019, and it uses a random forest of algorithms, and these are so named because it blends the output of thousands of decision trees, each containing a series of yes/no questions. Questions like, is inflation above 2%? Obviously, yes. It's trained on a data set of national price averages going back to 1990 and uses 25 different variables, such as price momentum, household incomes, and credit growth. During the COVID-19 pandemic, financial gyrations have caused its short-term forecast to be unusually inaccurate. But once economies open up, which they are now, 2022, the factors that have historically preceded rising or falling house prices should regain their predictive power, which is what they believe they have done. So giving equal weight to each of the 16 countries for which the model has data, its central estimate is that the rally is likely to stall but not reverse. It expects appreciation to slow to 3.4% in 2022 and to 0.7% by 2023. Much of this deceleration comes from America and Britain. However, because house prices are currently soaring in those markets, the model projects them to climb a bit further before reaching a plateau. Elsewhere, the model does expect house price declines, and its most dubious area, they say, is Spain, which faces a mix of deflation, high unemployment, and stagnant incomes. The most likely scenario is that prices there eke out a paltry gain in 2022, then turn south. Sweden and Canada also have unemployment rates above 8%, and the model predicts that they will start facing losses in 2022 and 2023. Among the big markets, the model is most bullish for the next 2 years on France and Germany, where solid fundamentals back up recent price increases. Yet by mid-2023, it expects annual appreciation of just 1.2 and 1.6% in those economies. The longest lived bright spot is Ireland, predicted to lead the table in 2022 and 2023, again in 23 of 2.5%. The model does not explicitly count Brexit-driven relocations to the EU's lone English-speaking country either, which I think will have another positive effect. Instead, it is impressed by Ireland's healthy numbers on jobs and incomes. Moreover, household credit in Ireland is far below the rich world average, implying that buyers have room to increase borrowing. Irish homeowners may still be scarred by the losses a decade ago. I mean, I had a property in Ireland up until the financial crisis, and it was a bloodbath there. But the data is they suggest that the Celtic tiger is poised to reawaken. Okay, thanks for listening. This week we're still away, as you can see, traveling the world. Why do we do this? I do this concept of the market wrap just to keep our clients and potential buyers knowledgeable as to what's going on in the marketplace, to see what the big research houses hopefully give a balanced approach. There's a lot of negativity out there. Long term, it's more positive. Thank you very much for listening. Do like, share, and press the button to remind yourself. The information today came from the Bank of England International Settlements, Bank of England, Bank of Canada, European Central Bank, European Mortgage Federation, Federal Reserve of St. Louis, IMF, OECD. So I look at lots of different places, okay, to try and give you a balanced approach. Thank you very much. Do take care. And where am I this Thursday? Do you like the shirt?